Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. With a brilliant summary of the history of index concentration and portfolio concentration. And I didn't realize, the way we have the big tech now.
I know.
This has been normal. There's other times it's been like this. In the 60s or the 50s.
Yeah, I'm not sure that's necessarily a healthy aspect of the market. I mean, this focus on a handful of stocks, a dozen stocks in terms of the market capitalization. Right. But that's where we are today with big tech.
We bring it up because Sarah Hunt joins us right now. Sarah Hunt with Alpine Woods Capital Investors. The top 10 stocks in our holding make up 142% of the portfolio. Have you ever seen it this concentrated?
Good morning. I have not. And I think that is something that we were discussing last year. It is something that is going to continue to be, but also we were talking about it last year because you had the top 7, right? They were a big percentage. They had to rebalance the S&P last year in the middle of the year, which they don't usually do because the concentration got so high. So that is something that we're going to continue to contend with.
Why do they do that? The fact is the index is the index. If that's the numbers, that's the numbers. So they basically made up fictional numbers because they thought the concentration was too much.
Well, I don't think that anyone anticipated the concentration becoming this high because you didn't think that you were going to have capitalization weighted that would become, like NVIDIA just reached $1 trillion. So you didn't think that was going to happen that fast.
Well, then we've just got the story out from Vian Vasilika of the $470 billion rally in Apple. Are these things under-owned? Is that really the shock here that NVIDIA or Apple are actually under-owned by American Wall Street?
Well, given the concentration in the S&P, relatively speaking, you could say yes about some of that. I think that even when people bought NVIDIA as it was moving up, it was racing so far ahead and it was getting a more and more side of the index where even if you owned it, you were underweight. And I think Apple went through somewhat of a correction and somewhat of a left behind era. And I don't think that people were holding as much Apple as the S&P is holding. But there's a risk to that too, because when something like Apple has a downdraft, all of a sudden, if you're 8% Apple, like the index was, that's a big problem for your portfolio.
So what are you suggesting folks do these days? Chase those magnificent whatever number they are, or try to find value outside of those big tech names?
I think it's a combination of the two, because chase is a word that I hate to use, but the big tech stocks that are generating tons of cash, it's difficult to say I don't want them in my portfolio even though the valuations continue to rise, because they're not in any kind of trouble. This is not the dot-com era where a lot of the stocks that were running were stocks that had to be financed by their vendors. These are companies that can pay for all of NVIDIA's chips, right? This is Google and Meta. These are companies that can pay for the stuff that that NVIDIA is building. But I also think you have to look around and say there are other areas of the market that are under-owned. I can look for good dividends. I can look for good cash flow. I can look for things like buybacks. And I can look for areas where I don't have to worry as much about that multiple. And then I can see what happens with the Fed, because that's a whole other iteration at the minute.
Right. Paul, downdraft, the pandemic, Apple down 35% into the October bottom, the Ed Yardeni, Ralph Ancambora bottom, Apple down 29%.
Yeah.
So those are the drawdowns.
Those are the drawdowns. Yeah. So, Sarah, a lot of things. How do you guys start off with just your allocations these days, equity versus fixed income? Because I'm very happy sitting in the 2-year Treasury getting darn close to 5%.
It depends a lot on the investor themselves. And, we manage a combination of individual accounts and then also funds. So I think that, you're looking at what someone's where they are in their investment life cycle matters a lot about what your fixed income allocation is going to be, and also what their risk tolerance is. There are some people that even though bonds have actually now have a yield, which they didn't for a decade and a half, people got so used to not owning bonds that they look at equity returns and they say 5% is not enough. But then you have a bad year like 2022 and you think, it would have been nice, although bonds had their own problems in 2022. So I think that there is a good case to be made for having an allocation to bonds. It depends on who you are, where you are in that cycle, and we also manage some balanced accounts. So that also, you want some of that fixed income, and finally it's helping you after years of not being available.
Do you see dividend growth? We just asked Contopoulos or Richard Bernstein this. Do you see dividend growth as a yield equivalent? Is it competing with yield, the Sweeney 2-year?
I think that it is. I think depending on the sector and depending on what the company can do, I don't want to see a yield that's growing because someone's going into debt to pay that dividend. But if I've got growing cash flow and I can increase the dividend, it's not necessarily going to give me what a 2-year is, but I also have some potential capital appreciation on the side.
The math of this is 30% of stocks succeed, 70% of stocks that don't. How do you choose that 30% winners right now, looking at 3 years or 5 years? What's the key determinant?
Well, I think that requires looking into or having a discussion about where you think things are going. If you look at the whole technology space that's getting bigger and bigger and bigger and has been for the last decade, it used to be it ran on cycles that were attached to things like PCs and phones. Now it's going on cycles of what is the car build? What is this? The industrial absorption of technology and the absorption of technology across the board has been incredibly rapid. Is that going to change in the next 3 to 5 years? I don't think so. Does it matter what you pay for these things? Yes, it does. So you have to keep an eye on both what you anticipate to happen and sort of say where industry is going to have problems. People right now think the energy industry is going away. It's going to be a much longer tail than people think, but it's a difficult area to have exposure to because people don't like it as much. But there is a longer term reality that we are going to be needing fossil fuels for a lot longer than people want to admit.
So I guess just stepping back here, how about valuation for this market? We've seen stocks run here. We've had good earnings. I'm not sure if the earnings are good enough to support the moves we've seen in this market over the last 12 months. How do you think about valuation?
Well, that's also, it ends up being sector dependent as well, because you see that the valuations in the technology sector are higher. You've seen some of that come down as the spend has shifted from things like software to things like chips, right? So there's a change there, and you have to be careful because some of those valuations in technology are very high.
Do you care about Apple today? Are you going to acquire shares off this meeting?
We own Apple already, so do we want it to go well? Yes. Am I going to add more to it at the moment? Probably not, because you just had the stock rally back another 10 or 15% in the last couple of weeks.
Nobody's talking about it. It's been an amazing rally.
It had a huge rally. So that was, but you didn't sell it when it went down, right? Because that's the participation that you have to continue to have.
Sarah, thank you so much.
Good stuff.
Yeah. Sarah Hunt, thank you so much.
Lori Calvasina joins us now from the lawn of the University of Virginia, head of U.S. equity strategy, RBC Capital Markets. So, Lori, what happens if this Federal Reserve says, you know what, the data does not support a rate cut? What happens to the market here?
Hi, well, thanks for having me as always. And look, I think that's a fantastic question. If you want to just go purely by the numbers, when we walk through that kind of scenario, getting, just no further moves by the Fed this year, no cuts, no hikes, stickier inflation than anticipated, and say 10-year yields, sort of settle out around the recent highs. Our work says that knocks the PE multiple down a little bit below 21 and pulls the S&P 500. If you're looking on my earnings, which are 237, around 4,900. If you're looking a little more generously at consensus earnings, which are around 245, you get closer to 5,100. But either way, we think there's some modest downside from here. We do think at this point in time, based on our modeling, this idea of getting 1, maybe 2 cuts and, kind of inflation coming down to 2.6 on PCE, that seems to be fully reflected in stock prices around 5,300 if you use the consensus earnings numbers. So we think we're fairly priced for that rosy scenario now. And if we don't get it, not a ton of damage to the market, but some, modest impacts.
Are you surprised, Lori, that the market has risen? I guess we're up 12% or so, somewhat this year, despite the fact that this market, again, went into the year discounting maybe 5 or 6 rate cuts, and now we're down to maybe 1 or 2. Despite that reduction in the Fed dovishness, the stock market's kind of risen here, 12%. Are you surprised by that?
Well, I think it's surprising from a Fed inflation interest rate angle. I think if you put it in the context of all these conflicting cross currents that we have, the big tailwind that's actually, I think, responsible for most of that appreciation is the economic tailwind. And so I love these stats, but if you look at the ECFC data on Bloomberg, and I look at this stuff every Friday, and you can track the consensus GDP forecast on the street, if you look at the 2024 number, last summer it was 0.6% for 2024 on real GDP on the annual basis. If you looked at that stat in January, it was 1.3%. And then I think it was sometime in February, we saw a big melt up and it crossed over the 2% mark. And now I believe it's sitting around 2.4% or so. 0 to 2% GDP is typically very weak for the equity market. 2 to 4, typically you get, kind of a 12 to 13% type gain. And that's about what we've gotten so far this year. So we've exited economic purgatory and we've moved into the idea that the economy is actually pretty healthy.
But Lori, small cap, and I don't know where mid cap is in this debate, I'm not informed, are in purgatory.
Yes.
We've been here before. I really want to emphasize, folks, I can remember times where small cap was in purgatory. What's the catalyst of big cap south or small cap north?
So it's a great question, Tom. I think small cap PMs have been dealing with this, for a long time, but really focused on, in this cycle, when are we going to get those Fed cuts? If you look historically, small caps typically do well in easing cycles relative to large, but unfortunately, they don't tend to pre-trade it. They tend to see the inflection after the cuts start happening. And that's why I think small caps, they're not really making major new lows relative to large cap right now. They're trying to defend their ground because there's still some of that optimism out there, but we really need those cuts to come through. I do think the economic tailwinds are also putting the floor under them under a relative basis. But at the end of the day, it doesn't matter how many charts I show people on the balance sheets. Hedge funds think they're worse than large and want to beat them up as long as the Fed's in tightening mode.
Good morning, Pleasanton, California. Paul, I completely randomly off Russell 2000 took Simpson Manufacturing, 5,500 employees. They're at a 19 multiple. Their dividend growth is okay, not great, 4% per year for a very small dividend. And what do you do in an Apple world? What do you do in Pleasanton, California, if Cupertino owns the high ground? I don't get it.
Exactly. Simpson Manufacturing. I hadn't heard of that one before.
Never heard of it. They do wood stuff.
Exactly. Hey, Lori, I know you recently attended the RBC Consumer Conference. How do you think the consumer's doing out there? What did you hear at that conference?
So, I will say it was a fantastic conference. We had a really interesting cross-section of companies. One of the big takeaways that I heard was that the high end is still relatively resilient, but the low end in particular, and we've heard this on conference calls as well, is really seeing the impact of higher inflation. And then I heard a number of auto-related companies, and so really got an earful about the interest rate impact as well. And if I think about that conference, and I also kind of go back to this last reporting season, I think a lot of the themes on the consumer are still the same: high end versus low end, all these pressures, resilience, yada, 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 value consciousness. But it does seem just like the tone has, gotten a little bit worse. I think the way our analyst put it in his recap report was that the negative tone around some of these issues just escalated.
Lori, a smart observation out on Twitter, I'll get it, folks, 3, 2, 1. YouTube, the live chat. Chris, thank you. Out on YouTube, the live chat. And Lori, he says, where's the profits in Russell 2000? I mean, are these people generating profit? Are they capital allocating? Are they on an EVA spread basis making money like the fancy people?
So look, if you look at gauges of profitability in small cap or earnings quality, definitely if you look at the Russell 2000, those metrics don't look as good as they have historically. They typically, you have a higher percentage of negative earners in the Russell 2000 than the S&P. That's true, but that gap has exacerbated over time. Some of that is because of index composition issues. You have a lot of biotech sitting in small cap. You have a lot of REITs sitting in small cap. Mm-hmm. So some of it can be explained by that. But if you do look at sectors like technology, you're also seeing more loss makers. Right. I think people do look at that to say, okay, it's a lower gauge of quality. The S&P 600 doesn't have as many of those issues, and it's still underperformed large caps as well. So I don't think you can blame small cap underperformance entirely on that. But honestly, Tom, people buy small caps for future growth, not necessarily present day profitability.
Lori, thank you so much. Lori Calvasina with RBC. We're blowing up the show. India, Modi.
Yep.
Macron, Scholz. Italy's doing okay. Belgium, the guy resigns. I remember interviewing him in Davos years ago. And I just said, get Terrence Haines. I don't care about anything else. Get Terry Haines with Pangaea. And he's here today about the ramifications, not for Europe, not for India, not for Belgium, but for Mr. Biden, Mr. Trump. Terry Haines, there's a message here. What should the Biden and Trump campaigns interpret forward to November?
Well, good morning, everybody. I think they ought to look at all these results very closely, including Mexico, South Africa, and the like.
Didn't mention that.
And Biden what Biden fundamentally needs to do is to actually double down on explaining, both his domestic policy and his foreign policy, not just in a pithy election way, but actually get to what the stakes are and why we need to be doing what we're doing. And this administration is bad at that. And I think, frankly, Trump's not much better at it. But they need to do that, not just because he's president and because he's running for re-election.
So, Terry, what we've seen in some of these elections and geopolitics around the globe over the past several weeks and months is the far right. I'm not sure if we can call them the far right anymore. Maybe they're more of the center of where folks are thinking about. But again, if you're President Biden here, you've got to be concerned about this, don't you?
Well, yeah, I think so. But what we're seeing here, I think, both in the United States and certainly in Europe. So the West as a whole is kind of a bonfire of the vanities moment. The politically entrenched don't seem to understand or really acknowledge their own roles in creating, over the last generation, policy and political cul-de-sacs that people are frustrated about. People want results, and we started to see that almost a decade ago with Trump, and we're seeing it again in Europe now. Whether or not the EU elections produce a real change is arguable. The EU elections tend to be more of a protest vote than anything else, which is precisely why a lot of people are scratching their heads about Macron's desire to go ahead and hold a snap election.
Terry just nailed it, as Terry Haines always does, talking about cul-de-sacs of people and policy and society. Did George Herbert Walker Bush do that, or James Earl Carter of the other team? I don't think they did that. I
don't. So Terry, if you're former President Trump here, what's the play over the next several months? Is it staying with that playbook that worked for him last time? Is that still the playbook going forward?
That's the playbook he'll run, that he thinks he needs to run. But he's in a much different situation, Paul, than he was in 2016 in three particulars. Firstly, he's not new anymore. He's not the new shiny big alternative that people are so frustrated about they were willing to take a flyer on. Secondly, he does not have a united Republican Party. He's got a split Republican Party. And if you don't believe me, watch how he's doing the dance with Nikki Haley to try to get her 20 to 40% of voters inside the tent. And thirdly, he's not winning independents. He's losing independents right now. So, he'll do what he does. And at the same time, they have to do different things in order to prevail, I think.
Terry, I think the heart of the matter, we're going to see this. Let's get out front, Terry, of all the op-edification in the evening news and the cable TV frenzy and all that. Ian Bremmer led with the inflation discussion off these elections and the harm to the middle class and lower class. Did we see a shift today where there's proof of concept that all that matters is immigration, migration, and green climate change? Did that shift happen over the weekend?
I don't think so, but the reason why, I think there's a shift happening, all right, but I don't think it's really those issues. Political people love to turn the dials and talk about issues, as if the right calibration of issues can help sell a candidate. This election to me is much more about what I call frame. And first, and it's up to Biden to set the frame. The frame is Biden's got to show that from now until November, that he's up to the job every single day, and he's particularly in the June 27th debate. And he's also got to show that he's the calmer, kind of more centrist alternative. And as Trump, kind of blusters. If Trump had better messages, discipline, he'd probably do better. We can't count on that after a decade. I doubt he's going to start. But Biden needs to do those two things. And if he does that, I think he's got a united party and he's got a pretty good shot at getting most of the independents he needs.
Terry, should Tom and I and Lisa, should we pay attention to these conventions this summer?
Absolutely. You should not. Let me tell you what you shouldn't pay attention to right now. You should not pay attention to polls. The reason why is they're all registered voter polls. It's like talking about people who might go to the movies to see the show, as opposed to the people who actually go. Guess which one Hollywood's interested in? The people they can actually get in, right? So same with polls. Right. But the conventions, but everything's going to get thrown up in the air after June 27th, right. Because if Biden does badly, the convention all of a sudden gets a lot more interesting and fraught. If Trump does badly, maybe same for the R's.
I got time for one more question. Terry, judge within the history and the remembrance President Biden's trip not only to Normandy, to Paris to see Mr. Macron, and also at Aunt Marne's cemetery, the World War I cemetery that we saw. Judge his performance.
I thought it was pretty much by the numbers, and that's a small compliment. I don't mean that to diss him. I think it was pretty much by the numbers. There's no magic there, but he showed. I think he showed at root that he, by and large, that he met my frame test. So he did okay.
Terry, hugely valuable. Thank you so much. Your daily look at the front pages on a Monday. Lisa Mateo.
Oh, let's get to the cost of owning a home, because this one is eye-opening. That's why it stood out to me. Increasing 26% since 2020. This is from Bankrate. Okay, it says because of different things, not even including the mortgage payment. We're talking about expenses, including taxes, insurance, utilities. They've all skyrocketed. So they crunched the numbers. It says the average of what homeowners shelling out annually for owning and maintaining, that's the big thing, a typical single-family home, totaled just over $18,000 in March. It's about $1,500 more a month than 4 years earlier, during the pandemic. They got the figure. They factored in property taxes, home insurance, energy costs, all that kind of stuff. 2% of the sale price for maintenance. So the states with the biggest jump, Utah, Idaho, Hawaii.
Did you say Utah up 44%?
Utah is the top, followed by
44%.
Idaho. It's crazy. And then Alaska and Texas actually saw the smallest increases, but it just goes to show you how much it's costing to maintain the house, not even to afford, the 7% mortgage or whatever that people are paying.
And there's a great chart in here. States where upkeep is typical, is priciest. The average in the United States is $18,000, $118 a year.
Yep.
But in Hawaii, it's $29,000. But our good friends in New Jersey, we come in as strong number 4 at $25,500.
But look at the New Jersey.
Yeah.
New York differential. It's $3,000.
I know. Thank you.
It's that much more expensive.
That's how we roll in Jersey.
I'm shocked. John,
all right, Lisa.
John Tucker never told me.
Yeah, John Tucker's his congestion report there.
I don't, Jennifer Epstein, thank you so much for writing that up. Really important story. And, I think there's a political tinge too. I look at the states, Hawaii, I think that's Democrat. In California, I think that's Democrat. But all the rest of the other states are Trump country. So it's going to be, it's going to fold right into that inflation angst. Very good. Next.
Gen Z, plumbers and construction workers who are Gen Z, they're making blue collar work cool again. Okay. We're talking hashtag blue collar. It's attracting a lot of attention. The Wall Street Journal actually spoke with a female electrician. She has like 2.2 million followers, TikTok, Instagram, Facebook. She posts everything she does every day. And she's getting stopped by people who are saying, you know what? You sparked my interest in this trade. I don't want to pay this high cost of a college degree. I don't want to be stuck with all this debt. I'm thinking of doing what you're doing. I want to be my own boss. Those are things that they're telling her. Vocational programs are on the rise. More people are joining them. And these people who are influencers at the same time, this girl is making $200,000 a year just from clicks on brand deals from like Carhartt and Klein Tools.
Cool.
That's just that alone. That's not even including her salary.
Are we influencers?
I don't think we're influencers.
Do you
No.
have 2.2 million followers?
Somebody can click.
Yeah. But I mean, I think you make it's totally correct. I mean, I think it's just the economics.
Correct.
Why take on that huge, college debt when you're unsure of what the payoff will be, as opposed to some of these trades, which we know their demand.
Age-old.
Yep.
It's never
I mean, my
wrong.
friend has twins. One is going to college. One is doing the trade. So
is that right?
They split
Okay.
it. Yeah.
Okay, very good.
All right, we'll check back with those twins in like 20 years.
Yeah, exactly.
Return on
Who's
investment.
doing better?
Right.
All right. Be careful how you drive. I'm putting the warning out there because certain apps on your phone could be giving your car insurance company information that could affect how much you pay. This is from the New York Times. It's interesting. Some of these apps that are on your phone, they're giving this information. Apps that people use a lot, like the One Life 360 that parents use to keep track of their kids. That's a big one.
Do you use that? I've never heard of it.
Yes. It tracks everything. You can see like how fast
Did
they're
you
driving
use
on the
it? Do you
highway.
use it? I don't.
I do track my kids. I do.
But he's a soldier.
I know,
You
but my
can't
daughter
track.
too. I got to find out where he is at all times.
But do they have to opt into it?
Yes.
Okay. See, all right.
We have the conversation.
Okay.
But then, you have that Apple Find My Phone, which does it automatically too.
Right.
I mean, there's other options.
You're a
But
digital-
it's
This Mateo's
telling
household,
you,
I would not do
we
well.
Crack down. But also if you have the My Radar, I mean, it gives weather forecasts, but it's also giving this data on how you're driving to insurance companies. Gas Buddy, that gives you tips on gas. Things on how you slam on the brakes, how fast you're going, how much
you
you're on
kidding
your
me?
phone.
Really?
Yeah, and it's becoming an issue. I think Allstate was one of the companies, which was there's a feature provided by an analytics company that was founded by Allstate. So that's how they're getting a pick. But not all insurers use it. Geico, USAA, they say they don't use this, but just
So
to
they
keep
say.
you aware.
Okay, all right.
Be careful how you're driving.
Thank you. You got one more
Lisa
for us?
Mateo may be following us, Tom.
I do.
I mean, for all we know,
I could be tracking you.
She could be tracking us.
See?
You got one more? Is that it?
Yeah,
One more, a
One
big
more.
cricket tournament over the weekend. Long
Yes.
Island.
Unbelievable.
34,000 people packed that temporary stadium to watch the T20 Cricket World Cup. It was India versus Pakistan. India actually winning 119 to 113. But a lot of people flew in from out of town, paid big ticket prices. One guy paid $2,500 per ticket for him and his son to go to that game. But it was the largest attendance at an international cricket match in the U.S. And it's not over. There's 3 more matches in New York. We have the final one Wednesday between India and the United States.
I mean, and the
So
United
it's huge.
States beat Pakistan, was
Yes,
it?
yes,
And
yes.
like, apparently that is just
That's like
unheard of.
That's like the White Sox beating the Red Sox this
Yeah,
weekend.
exactly.
I mean, but I've
So,
never seen a cricket match. Like, I don't know how they score it. I don't know.
Nobody
It's
does.
I'm
Nobody
kinda
does.
interested to find out.
I have scientific knowledge on this. I was exhausted from a round-the-world trip for Bloomberg, and I'm in a hotel, brain dead, in London. And I turned cricket on, and I was too tired to look at the screen. It sounds just like baseball.
Yes.
Yeah.
It sounds
Right.
just like the
Right.
audience sound is just like a sleepy July afternoon. It's a 6th inning. The kid wants a slush.
Right.
I want a Narragansett lager beer. It sounds the same, but I've tried and tried. I don't get it.
You don't get it.
I've tried, John Riding of Green Capitals helped me.
I
And
can't.
I
But
failed.
It apparently has
huge.
quite a following.
Billions watching.
Yes, yes.
Yep.
And that's Lisa Mateo with the newspapers. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.